All right, well, thanks to Jesse and Glenn for having me here. So the motivation for this paper is these questions, like, should financial transactions be taxed? All right, this, this goes back all the way to Keynes, but especially after Tobin, his speech in 1972, people refer to this type of tax as Tobin taxes. And there's been a lot of verbal arguments which often come back after periods of financial turmoil. So Tobin writes in 72, right after the collapse of the Bretton Woods system, in which there's a lot of financial instability. After the 87 crash, Stiglitz and Summers, there's like these policy pieces just talking about the convenience of this tax, but there's very little formal analysis into this issue. And even these days, after the recent crisis, Italy and France have unilaterally implemented forms of transaction taxes. The whole European Commission was trying to do a global tax for the European Union, and it seems that in the US, in this coming election, that's going to be it's a topic that may come into play at some point. It's not clear. So what I'm doing in this paper is a welfare theoretic analysis of transaction taxes. All right. So let me just briefly preview the results to you, and then I'll just jump right away to the model. All right. So in my paper, there are going to be three roles that financial markets play. The first role is going to be, you can call it fundamental trading, okay? And first, I'm thinking exchange economy. So think about fundamental trading. That could represent trading for risk-sharing reasons, for example, between people who have different hedging needs, trading because of risk transfer reasons, people who have different risk aversion, just simple life cycle or informed trading. You can put all these in this bucket, all right? But going back to this Keynes and Tobin idea, there is this notion that part of the trading that's going on in financial markets, you can attribute it to some non-fundamental reasons. And I think partly the challenge why there hasn't been a lot of work in this issue, it's complicated sometimes to think what can we call non-fundamental trading. So the way it's going to be modeled in this paper, it's going to be capturing this notion of speculation and betting, and it's going to be driven by belief disagreement, belief distortions. Okay, I'm going to be very precise about it in a second in the paper, but it's going to be the way I'm going to be modeling non-fundamental trading here. So for most of my talk today, I'm going to focus between these two legs, and I'm going to give you the main result, okay, which is going to be, I'll show you that very generally in a world in which there's both fundamental and non-fundamental trading, you expect a financial transaction tax to be positive in a world in which the planner assumes there's a single data generating process for payoffs. Okay, so that's going to be really the main result of the paper. There's going to be one condition on primitives, because actually you may find that a subsidy might be optimal under some conditions. I'll tell you exactly when that happens. I will show that doesn't happen on expectation. That's a bit more of a pathological case. So this is really where the main results are going to be coming from, and that's where I'm going to spend most of my talk. You could also think financial markets play a role through production. Okay, so what I do later is one of the main extensions is you append like a Q theory environment in which this financial market trading fits back to someone who is producing more shares or fewer shares of the risky asset, and then you have this Q theory environment. In that world, actually, it's not clear. You'll see there's another wedge that opens up, because you also have to control the amount of aggregate risk. And there, as you'll also see, like, transaction taxes are not a very good instrument to control prices. They are effective to control volume. So the effect that you have on prices may go in the wrong direction in that sense. So any argument that you see based on effects of transaction tax on production has a number of assumptions which are not as robust as you will get from the other trade-offs. So that's kind of the other main piece. And I'm going to spend most of my time on this. One thing that I'm not doing is I'm not talking about the role of financial markets as aggregators of information or the world of endogenous information acquisition. Actually, in the older version of this paper, there were some results on it. Now it's a full new paper that it's coming. I mean, it's going to be on my webpage in the next couple of weeks. Let me just give you the results for that one, which is saying, forget about what I told you, just think of the raw, think on a model in which there's a filtering problem that investors are trying to solve. In that paper, what I show is that having some kind of trading costs, there are two main results. One is for the role of filtering, there's no effect on it. Okay, so if the economy is formed by symmetric investors and you increase trading costs and they are ex-ante symmetric, both the noise and the information piece will move in a balanced way, so the ratio will remain constant. So that will be the main result there. When you have information acquisition, you can show, even in the symmetric economy, that everybody will acquire less information. Okay, so I'm not going to be talking about it, but I just want to be clear that those are another set of effects that you could append to have a more complete picture of what's going on. I'm going to be focusing really on this trade-off today. So in my talk, what I'll do first, I'll walk you through a baseline model. It's going to be a static exchange economy. I'll describe first the positive part of the economy, then I'll focus on the normative piece. Those are where the main results are. And then let's see how much time I have. I'll walk you through a number of extensions, both in the static model. I'll maybe talk briefly about dynamics, production, and then I'll conclude. Okay, so let me just jump straight to the model. So basically, the baseline model is the simplest model you have to model financial market. It's a current normal environment. It's a single trading stage, so it's like a date 1, people choose their portfolios. Date 2, uncertainty is realized and payoffs are distributed. Okay, there's a distribution of investors, which I denote by F. Of I is going to be the index for each investors, and they have carry utility with different coefficients of absolute risk aversion. Okay, there are 2 assets in which people can take unrestricted portfolios. So there's a risky asset and a riskless asset. All right, so the risky asset is going to be there's going to be a price P1, which is going to be that's going to be an equilibrium object, and it's in fixed supply. And actually, that's going to be important for a number of results. So I'll be clear about that when that matters. Investors are also endowed with some shares of the risky asset, and their main choice variable is how many units X1I, which is how many units of this risky asset they decide to hold between periods 1 and 2. All right? So you could think of it true, or it's not going to matter for a number of results, but you can think there is a dividend distribution, which is the data generating process for the payoffs. It's normal with some mean and some variance. And here it's where kind of one of the main, that's the way you model this disagreement among these investors. So they're going to have heterogeneous dogmatic beliefs about the expected payoff of this risky asset. Okay, so it's crucial here that this expectation is it's 1 per individual investor. There's going to be a primitive of the model. Okay, so each investor is endowed with 1 expectation about what do they think is going to be the payoff of the risky asset. Okay, you can also think of a model with a homogeneous prior, some informative signal, and these investors pay information to that signal. There are different ways in which you can model. The easiest way is just to think they have some given belief about what the payoff of the risky asset is going to be. Okay? On top of this, there's a stochastic endowment, which is realized in the final period and has some covariance with the payoff of the risky asset, and all these investors have some covariance with that. So that's going to create a hedging need. So if there's a positive correlation, they would like to short the risky asset. If there's a negative correlation, this is a good hedge. They would like to go long on it. Okay? So this is the full environment. I'm going to derive all my results today using this framework. Just to be clear, there are 4 reasons to trade here. 3 I'm going to call fundamental, 1 I'm going to call non-fundamental. So fundamental is going to be different hedging needs, different risk aversion, different initial conditions. Non-fundamental are going to be these different beliefs. Okay? From a positive standpoint, all 4 are equivalent. You'll see how the way I calculate welfare is going to make this last reason to trade different from the other 3. Okay? I don't need them all 3. I'd like to have them because I would like to emphasize that it's not something about a specific reason versus hedging versus beliefs. It's really fundamental versus non-fundamental. We're going to really put the focus on the belief in this paper. All right? So this is the environment. Let me just talk to you about the policy instrument. So it's going to be a linear anonymous tax. This is the single instrument in the hands of the planner. So I'm really setting a second best problem. It's paid by buyers and sellers on the total dollar value of the transaction. That's the way these things usually work. So revenue here, for example, would be like twice times the tax times the price times the change in the number of shares. Okay, so that's essentially the total revenue that the government's making. There's an assumption that's going to be in the model. That's something actually very important in practice, which can make this, you need to think carefully about it for anybody who thinks about doing this in practice. There's no tax avoidance in this environment, so people either trade or not trade, but they cannot trade somewhere else. And for simplicity, I'm going to rebate back the tax to whoever paid. So you can think this I is not only one investor, but many of them. That's not really important. And again, I'm going to be using Kaldor-Hicks efficiency, or you can think of they have ex-ante lump sum transfers to really focus on the efficiency properties, not so much on the distribution. You will see I'll be very explicit about this. Okay? So just formally, this is the utility of these guys. With this current normal environment, this boils down to solving a mean variance problem on the choice variable, which is the portfolio choice of the risky asset, and this is the return budget constraint. So in the period 2, that's the wealth of its investors, that's the exogenous endowment, number of shares times the dividend, and this is the stuff that goes into the risky asset, which is what they have minus what they bought, and the tax rebate component. Okay, so this is really the piece that's coming from the tax. So this is the problem by investors. Let me walk you through the solution to the individual problem. Okay, so that's a solution when there is no tax. When there is tax, as we will know in these environments, we have a linear tax. You're going to have inaction and dampening. Okay, you have a tax on the transaction, and essentially what's happening here is that what I'm plotting here is in the x-axis your initial asset holdings, and on the y-axis your net change in asset holdings. So essentially, if you are sufficiently close to the zero tax optimal portfolio and you have these linear transaction costs, there's going to be an inaction region. Okay, there's a first order, there's a price theory argument here, like first order, second order logic. If you're sufficiently close, the gains from changing a little bit, your portfolio is going to be second order, but the costs are linear, so that's what creates the inaction region. Okay, so this is how the problem looks. If you increase the tax, well, you expand the inaction region, and then you trade less. So from here, you'll be moving from here to here. So that's where I say this type of tax will create both inaction and dampening. As you will see, actually, the inaction is going to be important in some of the normative results. So even though it makes the problem much harder to solve, it has actually some meaning when you think about it. Okay? That said, the problem is still convex and well-behaved. So equilibrium is unique. There are no issues on the positive side of the model. All right, so the equilibrium, standard equilibrium definition, there's market clearing for this asset. There's going to be some price, which is going to clear the market. And these are the two main results I'm going to take to my normative analysis. So first, this is important. dp, d tau can be positive, negative, or zero. Okay? In other words, when you increase the transaction tax, price will go up, down, or remain constant. This may shock some of you because you may have the intuition coming from a more standard micro 101 type of result in which prices, like pre-tax price, tend to go down. The intuition here is the following, is that this is a model with fixed supply. So what you're really changing is excess demand. So when you put a transaction tax, buyers want to buy less, but sellers also want to sell less. So if you're going to sell your house and there's transaction tax, you are less willing to sell it. So this pushes the excess demand in opposite directions. So you may well have a model in which prices are not affected at all by the level of the tax in this world. And dx d tau, which you'll see it's important, essentially, this is just saying buyers buy less and sellers sell less once you account for all the equilibrium feedback. Okay, so these are really the two main results you want to have. And empirical papers tend to, this is always, essentially, all the results are, half the papers find that prices move one way and half the papers find the price go another way. So it's very much, it's not a very sharp test, but you really get similar predictions. Okay, so this is kind of really important for the results. So let me spend some time on this. So how will you assess welfare in this economy? And this is something that I guess comes up many times in these models with behavioral investors. So let me tell you the approach I'm going to take, and I'll compare it to other approaches. So what I'm going to be doing is I'm going to solve the planner's problem using a single belief. Okay? So the planner is going to calculate welfare not using the belief used by the investors to make their choices. It's going to pick a different belief. Okay? What I'm going to do next is I'm going to characterize conditions under which the solution to the planner's problem is independent of the belief chosen by the planner. Okay, so I'm saying, no matter which belief the planner picks, the solution to my problem is the same. So in that sense, this becomes like a consistency condition, not so much a specific pick of a given beliefs. And that's really one of the main results of the paper, why the paper becomes interesting. Okay, so this brings up the issue of paternalism, which is, does the planner respect investors' belief? And the answer is no. So in that sense, this planner is being paternalistic with investors. And that's how it is. Another alternative will be to respect what they are doing, even though this might be inconsistent. And in that case, this will be standard economy. All the welfare theorems will apply without any change. All right? Then there's a second question, which I find more interesting, which is, does the planner need to know more than the investors know? Well, the answer is not always. I'm going to give you some conditions under which that's not going to be the case. So that's going to bring to the table the idea that the planner doesn't need to know more information than the investors to set this tax, which I think is an interesting result. Okay, so there's there's a lot of recent work, some recent work talking about bringing up welfare criteria in similar environments. This paper by Meyer, Simsek, and Xiang in QJE. This work by Tom Sargent and co-authors using a different criteria. This work by Gilboa, Samuelson, Schmeidler, looking at axiomatic ways of doing this. The way I like to think about it is they're two complete separate problems. Once you take the step of going this paternalistic route, it's given the belief that you pick, you can identify wedges and conditions, and these are in general non-trivial problems. Okay? So if you can go to point 2 and find a condition under which the belief that you use doesn't matter, you kind of solve the problem. You don't have to go further and pick one given belief to solve your problem. In other words, when 2 doesn't work, I think these criteria have a stronger bite because they provide you some ways to deal with the issue of which beliefs you should be picking. So that's really the way I like to think about how these papers kind of complement some way my analysis and vice versa. All right, and let me say, I'm missing, as Glenn said, Dixon Norman's paper, but there's this, I think, well-known paper by O'Donoghue and Rabin on syntaxes, Chetty's presidential address, Manuel's new work, and I know John Campbell is giving the AEA LI lecture. He's going to have a full section on behavioral welfare economics, so I feel it's a bit of a trend that is there, so it very much fits along the lines of that literature. So let me just give you, let's start with the results. So this social welfare here, so I can trace the Pareto frontier with arbitrary welfare weights. It's social welfare, it's the sum, welfare weights, indirect utility, but it's not indirect utility with the belief with which the guys chose their portfolio, it's with the belief used by the planner. Okay, so X1 is chosen by investors, planners uses E instead of this E sub I. So let me first, I'm going to walk you through the main proposition step by step, and I'm going to spend most of my time doing that, so it's clear to you where the results are coming from. So dv tau, it's a marginal change in the tax level, so it's going to be the change in the indirect utility for all investors, given this planner's belief. And you can write this in this model as the expected marginal utility times the change in the certainty equivalent for these guys. Okay, so just plug it in, and then let me tell you how this change in certainty equivalent looks like. It has 3 components, okay, so I'll go one by one. So when you change the tax in this economy, okay, you're changing 2 things. On the one hand, you're changing the portfolio allocations that these guys have. Remember, this is the total derivative, so this takes into account possible changes in prices or other things that may be going on, and you also change prices, okay? This last term, let me actually go first with it. This is, I call it terms of trade. Is the idea that when you change this tax, you're going to change prices. So buyers, if the price goes up, they're going to be happy. Sellers are going to be happy. This thing's going to be zero-sum in a second. So this is essentially the term that you get there. And then you have like 2 other wedges that remain here. So when you change portfolios, on the one hand, you're changing, you have this wedge that comes out of the difference between the planner's belief and the belief held by investors, okay? So let me give you an example, for example, here. So dx d tau, it's a positive for, it's negative for a buyer, for example, okay? So if you're a buyer and I increase the tax, dx d tau is negative because you buy less, okay? So this, let's say this term is negative, for example. If you're an optimist and your belief EI is greater than the belief of the planner, this is also going to be negative. So you can see how this is going to have a positive effect on your welfare. So if you're a buyer and you happen to be optimistic, putting in a tax is going to create a welfare improvement for you. We'll see in a second how this plays with the optimal tax. So this is the first term coming from the belief distortion. This fundamental distortion is very much the same as a Harburger triangle. You have the sign function here because it's different from buyers and sellers, but you can see how this term's always negative for every guy. Okay, so if you're a buyer, dx d tau is negative, and the sign of this function is positive. If you are a seller, dx d tau is positive, and the sign is negative. So this term always going to be negative for every guy. Okay, so this is really what happens at the individual level. Now I'm going to put it all together, and I'm going to start jumping to do some aggregation. Okay, so first of all, this non-redistribution assumption is this Kaldor-Hicks quasi-linearity assumption. So essentially, if you had ex-ante transfers, you make this thing constant for all guys. Okay, you can say it's an assumption, as if, or you could actually do it directly. And this, or I mean, separately, you could think that you're maximizing certainty equivalence. Okay, so if you do that, you don't even have to make the assumption. But I want to be clear in the following sense that my results are going to hinge on the fact that you're looking at social welfare. You're putting the dollars of everybody together to make the maximization. If you have some kind of redistributional concern, for example, then the belief of the planner will be important because that will anchor where the economy is. Okay, it's the fact that you just look at the total amount of dollars, what allows you, as you will see, to get rid of the planner's belief in this world. Okay, so when you do that, this term goes away, and then you can start getting rid of more things. So market clearing tells you that the terms of trade piece is going to disappear. So that's a zero-sum game. In the sense like the winners and the losers, it's just a zero-sum there. And then what you can also do is you can use market clearing in a differential form, in the sense that anytime you change a tax, some people have to hold more of the risky asset, some people have to hold less of the risky asset. This is essentially what this thing is saying. And as you can see, that's what makes the planner's belief to drop out of the equation. Okay, so this is really the main, this is really where you get the main result. So planner's belief is going to drop out. It's going to be an identical policy for any belief that you pick. As I said, this is more of a consistency condition that some specific allocation you want to be implementing. What are the key assumptions for this result? No redistribution and assets in fixed supply. Okay, so when I go to production, actually assets are not going to be in fixed supply, so we're going to have another term that is coming out of there. But this is really what you get. So let me just kind of step back for a second. What have I assumed? There are all these reasons for trading. There are these reasons for trading done by these belief distortions. We've assumed that we have a single belief to calculate welfare, which you can think of as a consistency condition. In that world, no matter the belief that you pick, you're going to be able to assess changes in social welfare when measured with a Kaldor-Hicks criterion. So this is really what I've shown to you so far, okay? Now what I'm going to do is I'm going to go locally at 0 to try to understand what's the sign of this thing. You want to have a tax, you want to have a subsidy. Well, if you go at 0, this term is really, as we know, it's going to be second order, all these fundamental distortions for a small tax. So you can end up writing social welfare in the following way. You can write like this, and even easier, you can write like that. Okay, so what is that? Well, that's the second main assumption that you need. The one I told you was on primitives. Remember, this is evaluated at tau equals 0. So you look at the decentralized economy and have a very simple test which tells you whether you want to have a tax or a subsidy. Okay? And what you need to know is this: is a cross-sectional covariance of the beliefs with dx d tau, which essentially boils down to knowing. This is essentially telling you whether you're a buyer or a seller. So that's why I call this condition optimist buyers, pessimist sellers. Okay, so as long as this condition is negative, you would like to have a positive tax in this economy. Okay, and why do I call optimist buyers, pessimist sellers? Well, if you're an optimist, your belief is going to be really high. But if you are a buyer, dx d tau is going to be negative, as I showed to you. Okay, so for this thing to be negative, you're going to have optimists having dx d tau negative, which is exactly what you need. Is the opposite for sellers. Okay. Now the question is, will this condition hold? Do you have to test it? Do you need to know if it holds for economists or not? Well, what is interesting here is like you can give a result purely on theoretical grounds. Okay? Why? Because optimism and buying are not exogenous things. They are endogenously, they're going to be correlated by the structure of the economy. Optimistic people are more likely to be buyers. Okay? So essentially, if you assume that your portfolio holdings are a function of your beliefs and some other fundamental reasons for trade, and you think these two are somewhat orthogonal in the population, endogenously you always find that this thing is going to be negative or in expectation. Okay, so this is really the most robust result, given what I said. If you assume there is some form of disagreement and you take this view on how you calculate welfare, you expect for most economists to have a positive tax. Okay, you could also go empirically thinking about this. Again, so you can set it this way. So if that condition holds, you're going to have a positive tax, okay? And let me just walk you through the intuition. The way you want to think about it is the following. Let me give you, when I started this project, I always thought there would be some trade-off between fundamental and non-fundamental trade. And if there's a lot of fundamental trading, you would like not to have a tax whatsoever. What this thing is saying, it's a little bit different. It's saying, as long as there is a little bit of non-fundamental trading, even if you have this second-best instrument in which we're going to distort also the fundamental guys, you would like to have some tax. The intuition is this second-order, first-order logic in the sense that even for guys who are fully correct, they're going to be around their optimum, so there's going to be only second-order loss for them. But correcting these distortions, which are coming from the behavioral mistakes, are going to be first-order once you take this view on how you calculate welfare. So this is really what's pushing you towards the interior. Okay? Just one simple example. How can you have a subsidy? Maybe you're thinking about. Let me give you a simple example. Imagine you have labor income risk in your company. So you have pre-existing holdings of risky stuff, and the risky asset is the stock of your company. So ideally for you, you should be a seller. You should be selling the stock of your company. But now imagine that you're optimistic about it. So instead of selling 100 shares, you're only selling 50. When you put this tax, what the tax does is takes you towards no trade. So it's taking you towards selling even less. Okay? So if you had an economy in which those people predominate, then you have this OBPS condition not to hold. As I said, that could be somewhat pathological, but you need to kind of keep it in mind when you do the calculations. Okay? So, anyways, if the conditions hold, you have a positive tax, and here you get a bit of the sufficient statistic price theory theme. What is the optimal tax? How does it look like? Well, in this model, you can write it very simply as this: omega buyers minus omega sellers, which you can write this essentially as the average expected return of the buyers minus the average expected returns of the sellers. And here's where you get this result, which to me is, in this model, there are a lot of reasons for trading, but the optimal tax boils down to knowing the beliefs. Why is that? Well, it's a Pigouvian principle. The rest of the economy in this world is efficient. What this behavioral planner is trying to do is trying to correct those behavioral distortions that are there. So that's why the beliefs turn out to be the key variable that you need to be that you need to be measuring to do this, okay? You may also have these equilibrium portfolio derivatives. In other words, you give more sensitivity to the people who are, you give more weight to the people who are more sensitive to the tax, but with symmetry, the beliefs become really the true primitive, the true variable that you want to know to put this tax on there, okay? There's a nice result, but I won't have time to go into it. You can also implement this tax using a volume implementation, which I think is very interesting. You try to target volume as opposed to beliefs, but I won't have time to get into that. And you'll say, where is the numbers? Where I'm working, there's a broader question, how you estimate beliefs from financial data. We have another paper kind of working on that, kind of trying to recover these belief disagreements, but that's just like that's a big question by itself, which it's not necessarily linked to this, okay? So I don't have so much time, so what I'm gonna do is I'll just tell you the examples with words. I don't wanna get into them, so just to see the first example that I was gonna show you is just saying, imagine you have a world in which people only trade because of belief distortions. What I show in that world is that the optimal tax is the one that takes you towards no trade. Okay, so if you have the tax and this is volume, you can see welfare, social welfare is increasing up to the level of no trade. This is a kind of silly example because you think you may have some other reasons for trading. So what I do in this example is a richer case in which you have an interior solution for social welfare, price can go up and down, still volume always goes down, but you have a more meaningful interior solution. Okay, so sorry I went a bit fast on this, but I'd like to give you a couple of remarks and just talk you briefly through the extension. So there's actually a meaningful non-convexity in this problem. I'd like to show that because you will think this is a well-behaved problem, everything slopes down. How can you get the planning problem that is welfare and the tax to be non-convex? This is an example I cooked up. This is how welfare could look like on the level of the tax. But I think it has a very meaningful interpretation for practical terms. The idea is the following. The fact that you have the inaction regions into the problem creates extensive margin selection into trading and not trading. So if you had a world in which a small tax will kick out, for example, very good guys, you could think of high-frequency guys, which are going to be very affected. Then either you may as well have a very large tax or zero tax, not zero, like epsilon. But that's something that really comes out of the fact that the paper has both extensive and intensive margin in portfolio decisions. You can revisit Harburger's result when you respect beliefs. There's also like another nice formula that comes out of the paper. And let me skip this and just give you the last result. So other extensions you can do is you can have multiple risky assets. You'll get a weighted average of the tax for each asset market with the weights given by portfolio derivatives. In other words, the assets which are more sensitive to the tax should get a higher weight. If you have pre-existing trading costs, if you think those costs are like compensation for the use of economic resources, there are no other rents or stuff, you will go to that benchmark. If you're thinking about something deeper about rents, we can talk more about that later. That's totally fair point. Portfolio constraints you can also handle into the framework. And let me tell you, I didn't tell you this, but if you had multiple instruments, if you go all the way to the first best, just keep in mind what you are really trying to do in this world, if you had an investor-specific tax, is you will try to take the investors to the portfolio that you think is the right one. Okay, you're trying to remember the welfare losses here come from the fact that these investors are doing the wrong amount of risk sharing. Some people are taking too much risk. Some people are taking too little risk. So that's really what you would like to do if you had perfect instruments. Okay. What happens when you go to dynamics? I'll just mention the results. I won't go into all the detail, but you could write this model more generally in a dynamic model. You could allow for more general forms of disagreement, like Radon-Nikodym changes of measure. The first result that I like is that if you solve that more complicated problem, you have the optimal tax expression, and you take a first-order approximation. Usually people call this an Arrow-Pratt approximation. You recover the same results that I showed to you in the simple case. Okay, so I want you to think of it as what is the first-order effect of the policy, and that's what I was really doing in my simpler car normal environment. The other thing you have to keep in mind is that in this model, there's only one round of trading. If there were many rounds of trading, and these edges are forward-looking, as they are, so they take into account that when you increase the tax, you're increasing the tax today, but also tomorrow. So what you can show is that these forward-looking guys that buy and sell over time become very elastic to the tax. Okay, so the way to think about it is first you will measure these belief distortions, and holding the amount of beliefs constant, the fact that people trade in a more dynamic way will reduce the value of the tax. That's another insight that really comes out of the paper. Okay. So I'm out of time, so I'm almost done. So with production, let me just show you how the formula looks like. So in this case, the optimal tax has two components, the same component that we have from before, and a new component that focuses on the aggregate distortion, okay? So essentially, the new first order effect can be written as the planner's belief minus the average belief in the population times what is the effect of the tax on investment. In other words, if people are over-optimistic, which means that their belief is greater than the planner's belief, this is a negative term, and the SD tau is negative, which means that you reduce the number of trees being planted, that gives you another rationale for the tax, okay? So if you think it's kind of helping to stabilize the economy, that would provide another rationale. Interesting things is, if the planner thinks that people are correct on average, the second term will be 0. So we'll go back to the simple case, and there will be no other rationale for production. Another way to put it is to have a rationale for taxing transactions in a mall with production of the kind I'm analyzing here, you will need to make an assumption about people being systematically wrong on average, okay? The other insight is that since it's really hard to sign this dp tau, maybe it's not so clear that this is a good instrument for this type of environment, all right? So I'm almost done. It's just, since it's a broader conference, I'd just like to mention other papers. I think there's a broader agenda also in macrofinance topics. I mean, it's mostly more micro topics, but I have other papers on bankruptcy exemptions or deposit insurance fire sales, which are important for like macroprudential regulation, financial regulation, or even household finance. But they are all very much using these much richer models of risk and dynamic behavior. Just a bit of advertising at the end of the paper. So what I've tried, if I've given you a microfunded analysis of a financial transaction tax with different effects on non-fundamental and fundamental trading, important result is the irrelevance of planner's belief. Belief dispersion seems to point towards a positive tax. When you have production, things are a little bit more complicated. Thanks.
Thanks to the organizers for inviting me to discuss this very interesting paper, and also just for putting together a great conference. It's been a real pleasure. The first thing I want to say is this is a very ambitious paper. It's an ambitious topic. Financial transactions taxes are an old idea. They're credited to Tobin, commonly known as Tobin taxes, and some traces in writings of Keynes from the 30s. This idea of a transactions tax has had a large policy impact, as Eduardo's mentioned. It's resurfaced even in the current presidential election cycle. It's also surfaced in a big way in Europe over the last several years. And as Eduardo also mentioned, especially relative to the policy importance of this idea, there's a paucity of good economic theory on financial transactions taxes. It's small to non-existent. John Cochrane's called this idea an answer in search of a question, which I think is a nice line. And this paper comes along and claims to characterize the optimal financial transactions tax. It's a really ambitious undertaking, and I think Eduardo deserves a lot of credit for that. I'm not sure that I'm personally convinced that this paper teaches us what the optimal financial transactions tax is, and I'm still not sure I'm convinced that the optimal financial transactions tax is non-zero. But I really enjoyed reading the paper. I think it's provocative. I think it's mathematically quite elegant. It's a extremely parsimonious model that then yields a lot of rich analysis. You could see that in the talk, right? There's a one-page, a one-slide model that then yields a lot of insight and elegant analysis. And I think even if one comes away with some skepticism about the conclusion, which I do, and I'll try to explain why over the course of my discussion, I do think it's a valuable paper. It gives us a provocative new perspective on an important policy idea, and it's also just mathematically, I think, quite elegant and fun to read. So I want to spend actually a lot of my time giving some pregame to Eduardo's work on just the intellectual history of this idea of financial transactions taxes. So here's Tobin writing in the 70s. He's writing in the context of the debate on fixed versus floating exchange rate regimes. He says, I believe the basic problem today is not the exchange rate regime, whether fixed or floating. Debate on this regime, on the regime obscures and evades the essential problem. The problem is excessive international mobility of private financial capital. So the basic problems are these: goods and labor move much more sluggishly than fluid funds. Prices in goods and labor market move much more sluggishly than prices of financial assets. These facts of life are essentially the same, whether the exchange rates are floating or fixed. There are two ways forward. One is a common global currency. He then says, however appealing is clearly not a viable option. I therefore regretfully recommend the second way forward. And my proposal is to throw some, quote, sand in the wheels. And this is a famous quotation of Tobin now, of our excessively international money markets. These are the proposals of an internationally uniform tax on spot conversions of one currency into another, proportional to the size of the transaction. The tax would particularly deter short-term financial round-trip excursions into another currency. And then he goes through an example of the kinds of trading opportunities that, say, a 1% tax would deter. I do not want to claim too much for my modest proposal. It will restore to national economies and governments some fraction of the short-run autonomy they enjoyed before currency convertibility became so easy. Then he goes on to say that he hopes governments can take a longer range and more global view of their responsibilities. This is Tobin on Tobin taxes. Summers wrote a provocative and well-known article on Tobin taxes about 10 years later. He frames his article, and it's coming out of the 1987 stock market crash. Actually, let me go to this slide here. He gives a table in the article of the top 50 most volatile days in the stock market in the 20th century, and points out that in many of these instances, the stock market moved by large amounts for no apparent news. He says, in the narrow sense of permitting trade between consenting adults, it's obvious that our financial markets have become much more efficient over time, but he's worried about the freeing of financial markets to pursue casino instincts heightens the odds of crises. Quotes a Treasury Secretary approvingly as we're headed in the wrong direction when so much of our young talent, so much of the nation's resources are aimed at financial engineering, and so forth. So I think the way to think about Summers' argument and in conjunction with Tobin is there's three broad concerns that then give rise to a financial transactions tax as a solution to these concerns. Concern one is stability. Excessive volatility caused by speculation. This is exclusively what Tobin was talking about. We can debate whether we can put mathematical flesh to it. This is one part of Summers' argument. Two is rent seeking. And three is Summers talks a lot about short-termism. So rapid financial turnover might affect the way companies make investment decisions. Okay, now some context on the political discussion of Tobin taxes over the last few years. So here's the European Commission writing why it's proposed a pan-European transactions tax. So the financial sector will make a fair contribution to the cost of the crisis after benefiting from very significant financial support during the crisis, so retribution against the financial sector. Who benefits? Well, citizens and enterprises benefit through public revenue. This is my favorite part of the document. Who is most irritated by these taxation plans? They're most irritating for high-frequency traders. It'll have a strong dampening effect on a deplorable practice, a great irritation. I don't know if irritation means something different in European bureaucrat speak from the way I speak, but it's just an amusing document throughout. Here's Hillary Clinton talking about Tobin taxes. She wants to rein in excessive risks on Wall Street. And she talks about ensuring that everyday investors and consumers can trust that our financial markets work for them, not just for insiders with sophisticated, specialized, and fast connections. That's why we should impose a tax on high-frequency trading that makes our markets less stable and less fair. Here's Bernie Sanders talking about transactions taxes. So at a time of massive income and wealth inequality, trillions of dollars in wealth have left the pockets of the middle class and have gone to the top tenth of 1%. To impose a Wall Street speculation fee on Wall Street investment houses and hedge funds. Goes to detail the parameters of his proposed tax. And the policy is called the College for All Act. So it's really explicitly a redistributive policy of a 1% or 0.5% to 0.01% order magnitude tax used to fund college education for all Americans. So to stability, rent seeking, and short-termism, we can add two additional arguments for Tobin taxes in the pre-existing chit-chat economics literature and political literature, or political discussion. So one is response to unfair practices, And 2 is just redistribution. So I think that's really the essence of the way Sanders is talking about Tobin taxes. Of these, and I think Eduardo is right to point out that there's not much theory in support of any of these arguments. The rent-seeking argument is pretty easy to put some theory behind, so let me try to do that and tell you how to think about benefits and costs of a Tobin tax in the context of that one particular argument. So this is comes from my paper with Crampton and Shim. It's just a simple modification to the model in that paper to include a linear Tobin tax and identify the benefits and costs. So there's a security X that trades on a limit order book. X is worth Y. There's just some public signal Y that jumps around plus on. And there's 2 kinds of traders in this model. There's fundamental traders who show up, want to buy or sell some X. And there's snipers who, after a jump in the public signal Y, try to buy X at the old stale price. So what are the benefits and costs of a linear Tobin tax in this model? Well, the benefits are it makes sniping more expensive, which reduces rent seeking and ultimately helps liquidity, because sniping is an implicit tax on investors. What are the costs? Well, it makes fundamental trading more expensive too. And you can show it's pretty straightforward that for investors, the costs exceed the benefits, and how we evaluate it socially depends on how we want to view the revenue from the tax. The other thing you can see in this style of model is that Tobin taxes are relatively blunt instruments for addressing rent seeking. So empirically, the tax needs to be pretty large to put a dent in rent seeking associated with the high frequency trading speed race. And theoretically, you can show / see that it's just not a precisely tailored solution, a precisely tailored response to the rent seeking, because both rent seeking activity and fundamental trade get taxed, much as in Eduardo's model, how fundamental and non-fundamental activity gets taxed. And on a net, the fundamental guys are harmed, at least pre-redistribution. So for the rent seeking story, at least, it's pretty straightforward to show that the Tobin tax is directionally non-crazy, but it's a really blunt instrument. And better is to change the underlying market design to just directly eliminate what's viewed as the negative behavior. Okay, so what's Eduardo's argument for a Tobin tax? It's nothing to do with stability like in Tobin, nothing to do with rent seeking or short-termism like in Summers. It's not a fairness argument like in Hillary Clinton's speech or in Bernie Sanders. It's not about redistribution. It's a new argument. It's a paternalistic argument. There are investors in Eduardo's analysis who have incorrect beliefs, and a Tobin tax will prevent them from trading in a way that harms themselves. If they have all the same beliefs, if all of the EIDs are the same, then you don't need a tax. And you can also see that it's a new argument from the nature of the market design. It's a one-shot Walrasian exchange economy, which isn't the type of market design you'd want to use, even the dynamic version of the Walrasian exchange economy, for studying some of these other stories for Tobin taxes. So I think it's providing a new rationale. It's different from Tobin's in our argument. It's quite different, I think, from the current political discussion of Tobin taxes. And then once you see that it's a quite different rationale, I think it's a very nice analysis. And there are assumptions. You can quibble with the assumptions and therefore quibble with the conclusions. But I think it's quite elegant, a quite mathematically elegant analysis. One suggestion is, I think it will help expositionally to just be much more explicit about how different a rationale for Tobin taxes you're producing than people's preconceived notions about Tobin taxes based on Tobin and based on the political discussion. And this issue, I don't mean to pick on specific sentences of a paper. That's not really appropriate. But it does start on the first sentence of the paper, which is, should we set a financial transactions tax to curb speculation generated by distorted beliefs? And that's not the existing question in the literature or what the natural question to economists. The national question to economists is, should we set a financial transactions tax, period? Generated by distorted beliefs is your approach to a transactions tax, and that's completely legitimate, but I think you'll do yourself some favors expositionally by just being more clear that you're coming at it from a new angle. So what are some of my questions about Eduardo's argument for a Tobin tax? So one he covered quite nicely in the talk, so let me skip that. A second is, I'd like to see a bit more about who's helped and harmed by your optimal tax, as a function of how different their beliefs are from the truth and their level of fundamental desire to trade. And what I have in mind is that, and you touched on this a little bit in your discussion of dynamics, what I have in mind is there are some kinds of participants who are likely to have extremely accurate beliefs, and some types of participants who are likely to have much less accurate beliefs. It'd be nice to have some comparative statics on, or related type results on how your tax differentially affects different types of participants. And then another question is, in reality, the least sophisticated investors should just buy index funds and not trade very often. And it's hard to think about what that means in the context of a model like yours, where it's essentially symmetric participants when we all have different EIDs, but in different endowments. But there's not really a clean distinction in this modeling approach between you and me, saving for retirement, and a big mutual fund, and a big high-frequency trading firm. Different types of participants in financial markets. I just had some trouble thinking about how thinking about unsophisticated participants in that context. And more generally, financial transactions taxes aren't the only policy instrument in the world, either for thinking about distorted beliefs or generally for thinking about how to improve our financial markets. And so if you're going to make a case for optimal financial transactions taxes, you want to do so in a world that at least discusses a richer set of, an analysis that discusses a richer set of policy instruments. And then, so one last slide. So a key result in this analysis is that the optimal Tobin tax is strictly positive quite generally. And I should add that the mathematical conditions that deliver this, once you take the parsimonious setup of the model, seem reasonable. So the optimists are buyers, pessimists are sellers. That seems like a very palatable assumption. Should society act on this conclusion? I think there's three reasons for caution. So one is the generic types of concerns we might have about paternalistic policy interventions, which seem, I think, especially salient in this context because, and I guess not in some versions of your result, but in general, it seems like to get this tax right, you need to know a fair bit about investors' beliefs. Maybe not in a world where we know everybody has the same variance, for instance, but in general. So a second, and this you mentioned, is concerns left out of the model, such as tax workarounds and avoidance. And third is just alternative policy instruments for achieving similar objectives. Now, that said, given the prominence of financial transactions taxes in policy discussions and in the air, it's really been an idea that's stuck around for decades. I think papers like this one are valuable and give us new ways to think about an old idea, and it's a pleasure to read, and I look forward to discussing it with you further. Let me stop there. I'm a bit over time.
If you read the paper, there are a lot of insights which will apply more generally to other policies which are also there. So there's a tension, in my view, in the paper. It's like one thing is the stuff about how the belief distortions play a role, and the other thing is how does this specific instrument affect all the variables that play a role there. I think there's a lot of interesting analysis going on the second part. I agree, it's a different theory from the other ones. The way I like to think about it is, if you go and read Tobin as you did, and to read Summers, they're not internally consistent arguments in those papers, and that's the beauty of this price theory arguments. Like this paper is meant to be driven by starting from first principles in a world in which you have these beliefs, and then let's see. So that's the way I took the paper. I wasn't trying to cook a particular theory. I just wanted to start with the more canonical model you could write of financial markets, then see what we will get in, and that's part of the results. But I completely agree with you, Eric, and on everything. On the practical issues that you point out, I think I'm very clear about it, and in my view, there's a lot of interesting work to be done. Like this paper you mentioned of what happens in practice with evasion and avoidance and all these things. I think they're fascinating questions, which I don't touch. But to be honest, to be able to talk about those, you first need some kind of rationale for having a policy like this. So in my view, this was the first step along those lines. But yeah, I mean, I'm happy to take questions if people have any.
Jesse, please. So is the motivation for having the tax apply to the absolute value of the transaction size to avoid people gaming it by subdividing transactions?
Yeah. I had it note, but I didn't spend much time. It's the same argument you make why commodity taxes tend to be linear. This is the ultimate easy to game tax.
If you didn't have that constraint, is there a sense that, like if people could only trade in one unit, trade once per period or something, is there a sense that do you have a sense of what the optimal instrument looks like?
You want something anonymity is what's kind of giving you this. If you have something non-anonymous, you could do better. Let me give you an example, and I don't do this in the paper. Like, there are better instruments. If you have a dynamic model, for example, you could try to target people by their past
No, but even if you retain anonymity, you could still say, for the sake of argument, just to understand the economics, you could say, we're going to constrain you to trade once in a period, so that then you can't do the thing of subdividing your trade. So then, for example, you could have a tax on the quadratic size of the square of the transaction.
Yeah, you could do it. You could do it.
Just as a random example.
Okay, that would be easy. That would be easy to do. If you do something on linear, you'll do better.
Right.
I'm 100%
I'm just curious what
I don't know.
Okay,
I don't know the answer. You could do better with non-linear stuff.
Economics to understand what that would look like.
Yeah, that's what I don't know. Sorry.
Did you have one?
Yeah, I actually wanted to defend Eduardo a little bit more aggressively than he was willing to do himself against Eric's charges, which is to say that, look, it's hard to interpret any informal statement that's made that doesn't have a model behind it. But I view this as being spiritually related to some of the arguments that Summers was making. Because in Eduardo's model, what happens in equilibrium is that risk in the economy increases rather than dissipating as a result of this sort of trading. And it seems to me that a tax that's helping people not engage in stuff that increases risk is pretty spiritually related to an argument that highlights that risk seems to be increasing as a result of increasing liquidity of financial markets. Now maybe Summers is more concerned with the spillovers associated with casino behavior, but it seems like, reducing risk by a transaction tax is kind of like cracking down on casino behavior. And the second thing I'd say is that while it's certainly the case that FBAs target one very specific sort of rent-seeking behavior a little, somewhat better than Tobin Tax does, there's a huge number of other rent-seeking behaviors that I think we would all agree exist in financial markets. And I think there's some informal reason, at least, to believe that more robustly across the set of such behaviors, a Tobin Tax is likely to be directionally right in zinging them at least a little bit than our frequent batch auctions. So both are valuable instruments. They do different types of things. But it seems a little bit strange to focus on one particular rent-seeking behavior, say that could be better targeted by something else, when there's just a whole ton of different rent-seeking behaviors that a Tobin Tax might be useful and discouraging.
So, if I can build on that, I do think that clearly in the pros, there are certain channels which are just not in the model. Yeah. So I think that's right, that those channels are just not being explored by the model. That said, some of them could be, with a simple addition, with simple minor modification of the model. For example, you could start by asking, with having, say, finitely many investors or something like that, and ask what happens to the volatility of price, given the realization stuff. But that's just getting, but that's getting much closer, I think, to the respondent, because that seems much more closely to be looking at the kind of concerns that people have. Are the returns? It's a static model, but volatility of prices, is that going to be affected?
That's interesting. If you have here non-competitive investors, it's interesting because you have a fixed supply. So the fact that both buyers and sellers, the economy kind of behaves very symmetrically. They put it this way: if you had them non-competitive, they will both. There's going to be another wedge coming from the non-competitive behavior there. So people there are trading too little, so the tax might push in the opposite, in the wrong direction. In that way, we can. There are other ways you can think there is rent seeking, but you need to be specific about the rent seeking assumption. But I agree with you in the way you are.
This wasn't about rent seeking. This was about stability, right? You can make stability or some notion of it an endogenous object in this model. If you want to ask, is it the case that a tax is going to lead to less volatility? Now, why the volatility is bad is a separate model issue, but that clearly seems to be what Summers was. There's a reason. There's nothing in the paper to talk about that table about huge returns, negative returns in a single day. Is it the case that in your model, you can write down a model where that's an equilibrium possibility that gets reduced with a tax.
Well, I've made no assumptions on primitives. I mean, you could have endowment in the dynamic version, for example. You could have a sharp change in beliefs that could give you big changes in prices, but this still go through. I don't see what friction we have in mind that would generate a sharp drop in that, and that would be that would change the welfare properties of what I understand.
I think Amir has in mind that instead of looking at the calculated welfare, you just look at volatility per se as an objective.
Yeah.
But I don't know why. I think that was essentially the point. Like, I mean, there's no risk. I would like to see a model. If you had incomplete markets, for example, you're again inside the Pareto frontier. In the previous version of this paper, there was a more general model with incomplete markets, and that was a primitive friction. What you can show in that world is that there's one condition that determines whether a tax is improving or not in a world with incomplete markets, and it depends on whether the changes in price are going to improve the insurance that you get to investors or not. So I actually had a bigger point on that. It's not really a variance what you want, it's a covariance. You want prices to move in the right direction to provide insurance to those guys. What I show in that world, it's not in the paper anymore, I'm happy to share it. It's like, there's no prior by why this condition will hold in any of these models. So it will have to be something empirical like this, but I guess I agree with you.
You're assuming that there's no connection between the non-fundamental trading and the existence of the markets. And to the extent that you think that these are market makers, so we give them a slightly different name, and that's how they get compensated, that's a much different question. And that is a question that has been debated as to whether, say, establishing a futures market makes things better or worse. And volatility was the concern in trying to address that question. And the answer not quite obvious. Depends if you're getting rid of noise or creating noise in terms of giving planning signals to the economy. So I think it's a really hard. What I couldn't quite figure out is in your model, is there a connection? I don't think there is between the market existing and the presence of non-fundamental traders, or alternatively put, a market maker is getting compensated in this way, and if you put a Tobin tax on, they'll have to get compensated in some other way, or they'll have less liquidity. That's what I couldn't figure out.
Yeah, I mean, I guess there are kind of two different questions. One is, you could think of some of these guys as being market makers. There's nothing preventing you from thinking about it. That would be one answer. The other thing is whether, if you think, for example, in the case of multiple assets, because you have these inaction regions, sometimes markets will cease to exist altogether. So they will be just, you put a tax on markets, just stop existing. The analysis still will go through, in a sense, I mean, all the marginal analysis will go through, and you have these points which, by changing the tax on market, will drop, and there will be no trading there. Unless you have another specific friction on your mind that will be welfare relevant, for example, some kind of non-competitive behavior or something like this that will interact with the welfare, I think the analysis will still go through. The point I was trying to make is, like, for all these things, we need to really be very clear about what is the other primitive friction with which this tax is trying to interact, and part in this literature that wasn't clear back in the day. And just probably also to Glenn's point before is that any theory, something that you can learn from the paper is any theory that anybody may have about transaction taxes should be a theory by which reducing volume has some kind of benefit. And a lot of the theories we hear are theories that are based on price volatility or behavior in prices. So this kind of will survive all the other things. It's not clear that the other things would survive having the tax. That's kind of the other thing we can learn. Yeah.
Let's take our break and talk in the break. We'll come back at 3:45.